Hello, good afternoon. Can you hear me? Hello, good afternoon. Hello, good afternoon. Can you hear me? Okay, good afternoon, everyone. We'll start our lesson. Hope you can hear me. And today lesson will go through LO3, Learning Outcome 3. As you know me, my name is Anjum Sata. And if you have any questions, please drop me email anjum@dukeuniversity.co.uk and I'll try my Okay, I'll try my best to get back to you as soon as possible. This lesson is about LO3. During our last two lessons, we discussed about tax planning. We had a discussion about, different tax rate. We discussed about personal allowance. We discussed about VAT, different scheme, and today lesson will be about be able to taxation planning, be to minimize the deferred tax liability. So that will be the key in our lesson. So this week we are also looking the ethics, popular people chat in offices. Some people are very famous. They carry on so much chatting in at their work. So we can look around. The first be the professional behaviors. Always we need to be not conflicting information, keeping up to date, the knowledge, the professional competency that due care. That's why we need to submit, CPD record every year. Confidentiality, yes, of course, GDPR, not declaring information to client, a third party without, the permission of the client. Really, integrity is honest and objectivity, unbiased, and then without any conflict of our information need to be true and fair in light. So we can look around different rates, in different years. We had a discussion. We discussed about inherent tax, the parent subsidiary and associated the parent own uh, more than 50%, that will be the subsidiary. If you own 20 to 49% of the other company shares, that will be associate, and otherwise we call simple investment. So that's the key, which we need to be look around. Okay. We already had a discussion about M of this unit. It's always good to be when we start any activity, look around the tax planning ethics where we're looking, and always good to be reflect, how much I know about already about the tax planning and how we can plan the taxes, and what I know about ethics, because ethics are the moral principle. Every awarding body, we have the professional code of ethics, which is given by International Ethics Standard Board, and those really we need to be look around these, and we need to be fulfilled, and we as a accountant professional in a professional capacity, we have to follow these. Today lesson is our key indicative content, what really we're supposed to be learn and what we're supposed to be right, when we'll do assignment under this learning outcome. Range of different, investment and other expenditure that may result in the reduction of the tax liability for individual and both incorporated and unincorporated businesses, like individual and or companies, sole traded partnership and companies, and be able to advise, and appropriate each of these type. Understanding the legitimate tax planning, mitigation of tax based, on the numerical analysis and reason argument, and we look around the ethics and the professional and current issues in the taxation in the UK. That's the key. We already had a discussion about, whichever year finance act you're following, because up to always good to be follow the latest, because up to 31st January we can follow the previous year finance act. Always good to be look around, which is mean we can follow 24, 25, and then of course 25th. That's, which we can follow after the 31st January. That's normally the rules really we need to be followed for the rates and the tax return purposes. Yes, base rate, high rate, and additional rate. We discussed about 20% tax apply after 12,570, and then additional rate, and then of course, higher rate will apply. So we need to be look around those rate accordingly, and the rate need to be charged. And we discuss about personal allowance, transferable amount as a marriage couple, and income tax limit. Where is the tax? Where is the personal allowance allowable after every 100,000 pound. If you every pound, if your personal allowance will be half, so that will be zero if you are 125,000 above. So we need to be looking at the child benefits. We have to, those will be reduced and charge the tax, after the 50,000. Those we need to be look around in the line, the, of course, we can look around different cars and different car benefit in kind. Those, which we look around in term of different pension scheme, annual allowance, minimum allowance, and all, the income limit, which we need to be look around 200 a lifetime. So the motor car, yes, is the CO2 level, so which is 100% exempt. Second hand car is 18%, and the CO2, when we can look around the personal allowance. Corporation tax is 19%, and please, which we need to, inherent tax limit is, of course, up to 325,000, no tax. Annual exempt limit on the capital gain is 6,000. Then of course we look around the commercial and Indian private residential properties, and these rates will be applied accordingly. The class one and class two and the insurance rates, those we need to look around according to whichever finance act will follow. Let's we look, evaluate our 3.1 assessment criteria. Evaluate the types of investment and expenditure resulting as the reduction in the tax liability. Current annual investment allowance, which is uh, 1 million, and will be continues to apply. The in exam, of course, you're not doing exam. We're looking just assignment. So in assignment, we can add these examples. So capital expenditures. If you have the property, plant, equipment, we are authorize the capital allowance. So that's we need to be look around our written down allowance. So annual investment allowance on the plant machinery, with the exception of the cars, which can be the limit appropriate, reduce or increase where the period of account is shorter or larger than 12 months. So we need to be looking on the proportion accordingly. And annual investment would be 250,000 if it's 3 months in, and that's of course, you divide it so on 1 million, so you have to proportion accordingly. Okay, let's we look, the example here, please. You've been given, and these example we picked from ACCA handout or any other example which you want to use for. So 8 April, the car purchase, and then the second car purchase, the proceed. So we can look around the CO2 emission level, and we can look around and we can claim, capital allowance accordingly. So that's, you have to look around the rates, and we need to apply. Let's we look in this, which we looking the year end is 31st March. Written down value of the brought forward, which is 16,700, and additional annual investment allowance. Equipment, we have a 98,750, and annual investment allowance, which is 100% exempt up to 1 million. So that's which we need to be look around. And then of course, so we allowance which is available for this, which we can, and the previously allowance which will bought, which we look around those written down allowance carry forward from the previous year. Then we have the other, additions. We have the car, which we have the 28,300 that falls in the man pool item. Our item is the short life item and the special pool, so we need to be look around the capital allowance and the asset categories accordingly. We need to be according to CO2 and all emission. So that's, total. And then of course written down allowance, we have a 18% of 45,000 in this case, and special, which we can again 18%. And then we have, so we can look around the special pool. Please, we need to be the car proceed which we sold off, and the remaining, which we need to be look around those perspective. And of course we need to be proportion of, so according to the months, or the period which we need to be designed. So that's, which we can look around in this case. And additional qualifying, the car we have 16,800 and first year allowance can be 100%. So which we can get first year allowance of 100% in that case. So if you are 16,800, so that's, which we can. So if we look all the allowance, that's which we can claim against the profit if we have the year, because the asset is bought and these are capital allowance which we can claim. Okay, so you will see the explanation of the CO2, the car emission level in that case 18%, the CO2 emission 50 gram per kilo meter. Therefore, the qualifying written down allowance at the rate is 6%, even though it's only the asset is the special rate pool and there is a no balancing allowance and disposal of this car because the expenditures include in the pool. Okay, so CO2 emission 1 to 50 gram kilometer, it can be up to 18% as a man pool item, and the car has a zero CO2 emission, they can be 100% in the first year. So that's, so we can, any car in which falls in the CO2 is 0.7 can be goes under the special pool. So the new car, the zero emission qualify 100% the first year allowance. The cost is effectively deducted and expenditures in the year of purchase. If the provided in the company car, 2% of this car benefit, the percentage is available of the minimum income tax implication. Other implies and only the small amount is class one, so those we need to be look around according to the classes again. Low emission cars, therefore the beneficial, especially director who also 100% the share in the on the company. Okay, so the annual state line allowance, which is 3% with the relief given over 33.13 period of 33 years, 4 months. So we need to be look around these, so the structured building allowance is only available for the building constructed between these years and will be set off. So that's, which we can. Okay, so we included example here, please, which we can. Accounting reference limited. On the 1st July, the company purchased newly constructed factory from 470,000, including the land of 110, and the factory was bought into use on the 1st September 2023. The qualifying expenditures are the company, which we can look around 470,000 minus will take out the land the factory bought into the use on the 1st September. So the year end is 31st March, and is we can claim because for the 7 months, and we can claim 3% of that because that's, the period which we need to be look around and we need to be proportional. So annual allowance for 10,800 we will be given in the subsequent years. So that's, which we can claim. So that's really we need to be look around and proportions accordingly on the 360, but the first year because that wasn't whole year, so we need to be proportion. So that's, that need to be written down aloud, and we need to be make sure we'll make adjustment accordingly. That written down the claim early possible, written down every year is the ownership except the year of disposal, balance pro allowance, and the balancing charge. That's all we need to be look around. So original asset bought, the cumulative allowance claim, the written down allowance, the value of the asset, disposal value, and then we can look around either we have a gain or loss on these. The losses can be carried forward up to 5 years, and the asset is assumed to be bought in the zero, which is mean the base year, the end of the accounting period, and there is no distinction between the date of discounting and the tax purposes which we can look the allowance and proportion according to the period, which is mean you can look around different time frame, and for investment appraisal question, which is we can net trading, the total taxable and total relief written down, which we can claim. Okay, so pension and the other relief, which we can look around the pension contribution to the pension scheme, enterprise investment scheme, seed enterprise, investment scheme and venture capital. Those we can look around last release. Again, the total profit before, total qualifying, and again, the future total profit. That's, we can carry back our current year, which we can claim back. So let's, we look the when the company tax planning for the married couple the civil partnership, we have to look around the saving income and who is the taxpayer, high taxpayer, low taxpayer. So, like in this case, well, salary is 90,000, Samantha's salary is 30,000, saving income 50 and 100. Samantha is the basic, Sam is a basic taxpayer in that case, and her saving income will be rate band is 1,000, and the remaining 500 of her saving income will be taxed, at the rate of 20%. So in higher taxpayer, so his saving income nil rate and band is 500, crossing sufficient saving to well, so the tax receiver 500 saving will be there for the save income tax of 100. Found, and we can look around the planning tool. We can transfer these between husband and wife and all. So that's tax planning is illegal, which we can plan things accordingly. Okay, the dividend, the first 1,000 dividend for the tax year 2023-24, the benefit is zero rate, and almost the rate stay the same for this year as well. So 1,000 nil ban available for the taxpayer regardless where the basic or the higher or additional taxpayer. However, the dividend nil rate band count toward the basic rate, higher rate band. So the dividend income excess of the 1,000 nil band is the tax 8.75%, below the basic threshold 30,000, 37,700, then is a 33.75%. That's, and because the personal allowance that is we need to be look around in that the threshold. So those will apply 39.35%. So employment income, dividend income. So this is also example, the personal allowance, which is still 12,570. We minus and we said, how much, because the first 37,700 will be 20%. Remaining will go the additional rate, the total tax liability from employment income, which we can look around. Others, of course, 2,800 is the dividend. First 1,000 is zero, and then 1,800 will be 33.75%. And then that's, the total liability which we have altogether 13,000 £40. If the tax is being paid through the pay why that's we can minus, and then the remaining we need to pay the tax accordingly. So that's, I included these examples. So in our assignment purposes, we can pick any example which we can. In next, is the case of if you have the saving income dividend, we need to be proportion and we need to apply the rates accordingly. That's, the key thing with guys, please, we need to look around the rate and the finance act we need to apply, because this is assignment based course, is no exam, so easy we can look around and pick the example and we apply. Of course, if you're using any particular software, we can generate the statement by based on the information, and we can look around. So must claim again the current year profit first, previous year 12 months if we have a losses, qualifying period up to 5 years, which we can make adjustment. So the trading losses automatically carry forward, the back claim, have not been made. That's, which we can. The first of all, trading losses, of course, can go up to 5. That's all, but we can look around whichever years, and we can go up to 5 years backward or forward. So that's, which we can claim back if we have outstanding liabilities, and we can make adjustment. So that's, which we need to be capital losses automatically relieved, again the current year, and those we need to make adjustment accordingly. That's, plenty of IR35 anti-avoidance legislation, called IR35 of the press release announcing this. Further, we need to be look around the contract control and the related engagement within HMRC, and is it not clustered as a self-employed, and we have to do the reporting for and the signs, of the relevant engagement. The worker cannot send the substitute. The worker is provided the tools and the equipment, the client company and the work. Okay, sometimes please we have, if you want to work toward the merit criteria and all, evaluate the mitigating when the tax provide tax planning advice to the client, and you the full responsibility for advice. Give fundamental principle. We need to be look around ethics, arrangement with HMRC. If you disagree with the conclusion of the tax, consequences, explain the client the full details of the given HMRC and consider the matter accordingly. Of course, I included the link there, please, if you want to be look around current further years, professional code of ethics, which we discussed earlier. These are five, really we need to be follow five code of ethics. Those are tax evasion, of course, TEM is the threat to be fundamental principle. Those we need to be money laundering, of course, we are member of, and those we need to be follow all the required legislations accordingly and disclosures of the information. Direct tax avoidance scheme is a parameter tax avoidance scheme, related to the direct taxes, income tax, national insurance contribution, capital gains, and various other inherent disclosure obligation. The taxpayer disclose, details of the scheme of the certain cases and notified, So those we need to be any person who fall comply with any disclosures provision liable the penalty not exceeding 5,000. Those we need to be advised accordingly. Of course, VAT scheme, we know different VAT scheme we discussed in the lesson one, annual accounting, cash accounting, and various, so we need to be look around previous date was now it's 20%. So we need to be look around which years we fall. Okay, so real tax avoidance, of course, that can lead to the number of consequences. The advantages would be expected under the tax not be available for HMRC obtaining the favorable courts of the tribunal ruling. Those we need to be in terms of the legislation and penalties and damages can be leads to. So ethical tax avoidance ethics, the fundamental principle, direct disclosures, conflict of interest, tax planning, prospect of the client, and tax reality in not regularity, those we need to be look around the money laundering, tax avoidance scheme, direct avoidance scheme, VAT, and the CG of the tax avoidance. Those we need to be look around and we need to be follow these. And if you please, when we'll do the merit criteria, we can add, more example to address these. So we included like, the threads to the code of ethics, which is five threads that can lead to the compromise, the professional code of the self-interest, like, having financial interest in the client and depending upon the client fees for the significant proportion coming from the same client. And that's, because you're influenced by the clients, that it can be conflict. Self-review checking on work are the close, so those we need to be familiarity, knowing number of years, close family relationship, that's, also lead intimidation, senior, junior can intimidate, that's, the can be objectivity can be compromised, advocacy acting on the behalf of an audit client and which is dispute with the third party, and if you give advice to the one, you can not advise it. So either you member in practice or member in businesses, we all have to follow these professional code of ethics. We have clear compliance procedures in place and we need to be follow these. Okay, so yes, for an element, if you want to be look around the merit criteria, which we can add, some example we added to address. So purchase of properties and capital allowance, and where the company's head office is, an investment scheme, different schemes we can look around. In particular, these, some example which we can pick, from F6, uh, which is ACC, and we included the links there. And further, the links available on and the books I already shared with you during our lesson one. Anyone, any question, please? Okay, Kiran, any question if you like to ask? Okay, I hope you can hear me. Okay, thanks for attending to this session. Today we discuss about our LO3, and the next lesson we'll go through our LO4, and then we'll do assignment discussion. Have a lovely long weekend. Hope so speak you all during our next lesson. So please, if you have any question regarding the particular scenario in the text, we can, of course, we can deep dive into, and we can look around different rate and different scenario. And that's, and we can add some examples to meet the criteria, which I included some. I gave you the booklet, which we can use, either we can pick ACCA or Kaplan and various other books, which I gave you last time. Thanks for attending and have a lovely weekend. Hope speak you all during next lesson. Thank you. Bye-bye.